All right, I'm kicking things off with your daily guide to the biggest market drivers of the trading day. Here's what I'm watching. Number one, twisting the data. The July Consumer Price Index is out, and it showed a slight acceleration in core inflation versus June as tariffs began to take greater hold. The CPI index, excluding food and energy, rose 0.3% in July, follows a 0.2% increase in June. However, the market appears to be taking its initial cue on inflation holding relatively steady versus estimates and year over year. That leaves the door open to what the market is betting on: 2 rate cuts from the Federal Reserve this year. So how should one interpret this data? We'll dive in. And number 2, the race to be the next Fed chair. President Trump's interview list to take over the top Fed spot from Jerome Powell is widening. Both Federal Reserve vice chairs, Michelle Bowman and Philip Jefferson, as well as Dallas Fed President Lori Logan, are under consideration for the role. They join Christopher Waller, Kevin Hassett, and Kevin Walsh as top contenders. My roundtable for today: Jim Bianco, Bianco Research President, and Yahoo Finance Senior Reporters Brooke, DiPalma, and Ines Ferre are here. Jim, it's been a while since we've talked. Good to see you here. Thanks for hopping on the show. Love to get your initial take on this, on the CPI data and what it may mean for the Federal Reserve or may not. Market seems to like it. What say you?
Yeah, the market seems to like it. The market seems to think, well, it seems to think that the Fed is going to cut rates in September. Now, whether or not you want to say it likes it is a different question, because the 10-year yield is now at the highest point it's been in 2 weeks after a brief rally, in the minutes after the release. I think that the market's going to have to come to grips with the Fed's going to cut rates, and is it going to be the right move for the Fed to make? Now, last year they cut rates, and the market decided it wasn't the right move, and it shot yields on the 10 and the 30-year up over 100 basis points. I think that's the risk we face right now if the market decides this is not the right move.
Jim, I've talked to 4 economists in the past 24 hours, and they all have told me we might not see inflation per se in this report, but Brian, it's coming, and it's coming in a big way. All these goods that have been on shelves, major retailers, for example, those reflect prices from prior months. A lot of the stuff now hitting shelves reflects tariff prices. How could the Fed cut interest rates if this, in fact, is going to happen?
That's a good question, and that's really the big question that everybody's asking. There's about an extra $250 to $300 billion of tariffs that are going to be collected over the next year. Tariffs were running around $8 billion a month. Now they're running nearly $30 billion a month. Somebody's paying that extra $22 billion or so a month. Who's paying it? It's showing up in some prices somewhere. We just don't magically have $250 billion sitting somewhere that no one saw that the government is raising. Is it coming from the exporters cutting their prices? Now, they were. The Japanese automakers were cutting their prices in April and May to protect market share. But in June and July and into August, they're raising their prices again. So I think you're going to see those numbers come, and you're going to see inflation start to show those tariff numbers as we move through the rest of the year.
Jen, we'll get various Fed speak over the next few weeks in the lead up to that key Jackson Hole symposium. Do you think these various Fed members will use this opportunity to throw out a few more trial balloons on a potential rate cut, starting in September, I should say?
Yeah, I do think so. I mean, right now, what you've seen with the nuance within the Fed is those that have come out very dovish about the Fed, other than Michelle Bowman, who's a governor, who dissented at the last meeting, are non-voters. So these are people that are not going to vote. We haven't really heard from the voting presidents, and we should be hearing from them. And then that Jackson Hole speech is going to be basically one question. Are you going to cut rates in September or not, Jay Powell? And I think that that's really what he's going to have to answer. And I'll go you one step further. If he says he's not going to cut rates, I would then put Trump firing him back into play.
Jen, let me get over to you here. Michelle Bowman recently came out suggesting 3 rate cuts before year end. Is that still likely based on what we saw out of the CPI today?
I don't think it is, and I'm sorry. I'm going to have to pull the political card and say, yeah. And she also interviewed to be the Fed chairman, and we also know what the president wants. So I'm going to leave it at that and let everybody make their own decision from it.
Jen, Schomburg, let me get over to you here. Brooke, actually, on all things Federal Reserve. What are we seeing in terms of prices?
Sorry, what was that?
Brooke, what are we seeing in terms of prices as we dig through the CPI report?
Yeah, well, certainly we've seen retailers invest in pricing over the past few months. For example, On out this morning being rewarded by investors if they've been able to navigate this, this impact, especially since they source from Vietnam. That country got a 20% tariff on their imports to the U.S. And what they were able to do was raise prices on key items like apparel and not necessarily sneakers in July in order to offset some of those costs. We also heard from other sneaker giants. Sneakers are really the ones that are getting hit the hardest by these tariffs, as well as other key companies like furniture companies as well. And what we heard from Nike was that they were going to implement a surgical price increase. And so largely what we've seen is not only prices be adjusted to offset these tariffs, but in addition to that, what we've also seen is them going back to their manufacturers and hoping to mitigate some of the impact of these tariffs and work with them. And so right now, because of these trade deadlines moving and moving and moving, we've seen them sort of go back and forth about what exact mitigation tactics, so to say, that they're up to right now. But certainly, for example, On, they've been able to raise prices. They've been able to offset one of the biggest fears that the market's had, the impact of tariffs hitting not only demand, but also their production as well.
Ines, let me get you into this conversation here. Jim brings up a good point. The market has rallied as rhetoric on President Trump potentially firing Jerome Powell before his term ends has cooled down. But if that returns, I can imagine that's the last thing the bulls want to hear here.
Yeah, look, right now the Fed is in a tricky position because of that soft labor report that we got recently. And now with this, services look sticky in this inflation print. And this is very difficult because you're looking at shelter, transportation, medical care. Those are things that people need. So if that is sticky, what does the Fed now look at CPI with excluding shelter perhaps? Or I'm going to say something controversial. Does the U.S. eventually go to a 3% inflation rate or target rather than a 2%? Because we are seeing that inflation, at least on the services side, is stickier than what they want. And at this point, if Powell doesn't indicate that they are going to cut in September, then that will look very political as well. So he's really caught right now between a rock and a hard place because you have this situation where the market is expecting a cut in September. And if the Fed doesn't cut, it's going to look political. And as Jim said, you may see Trump putting Powell back on the firing block, so to speak.
Jim, before I just want to tie this part of the conversation in a bow. If you have been long this market in the potential or the hopes that we get 2 rate cuts before year end, is that still the play here?
I mean, that is what the Fed seems to be going for, is that I think if you've been long the market expecting 2 rate cuts, what you're expecting is you're expecting 10-year and 30-year yields to go down. You're expecting mortgage rates to go down. Well, they're not. They're going up right now. At least they have been for the last 2 weeks or so since the employment report. They've been drifting higher. And if you look back to last year, I said this before, when the Fed cut rates in September of last year, the 10-year yield was 3.6. In January, 4 months later, it was 4.8. That's the thing you're hoping for, is that this is the right move. Cut rates. The market agrees with you that this is the move. If it doesn't, cut rates and look for 5% 10-year yields. That's the risk you face with this market right now.
Jim, this list to succeed Jerome Powell is widening out. I would argue many average investors have no clue on who most of these people even are. Handicap this for us. Who would be the best person to lead the Fed if one is bullish the markets?
The best person to lead the Fed is probably the more independent-minded type of people that you would probably get. Some kind of outsider that would be willing to change their mind. I would probably say the list, a Warsh or a Bullard would probably be my favorite picks, at least in that regard. I think the worst pick would probably be Bill Pulte, who's the FHFA. He's the Federal Housing
Finance. He can't be getting this job. Come on, Jim. No way. Bill Pulte. You see his X account? Oh, no, come on.
Yes, but see, Bill Pulte has 2 things going for him. He's got 3 things going for him. 1, he's a billionaire. Trump loves billionaires. 2, he will cut rates to 1% come hell or high water, and he doesn't care what the data is, and that's what Trump wants. And 3, he passed Senate confirmation for the FHFA, and so that's another plus for him. Now, like I'm saying, I don't want him. I think he's the worst choice, but don't rule him out.
Ines, 1% interest rates, that would be great for the bulls.
Oh, it would be very great for the bulls. Look, I mean, as you just were mentioning, look, the markets have been expecting these lower rate cuts. And even when you take a look at the tariffs that have been implemented, they're expected to be, on average, 15 to 18%. And analysts are saying, look, this is not this won't derail the economy. This shouldn't derail the equity rally that we have been seeing, though you could see some volatility in the near term.
All right, straight ahead, I'll tee up your guide to CoreWeave's big earnings report today, and Intel is still very much in focus amongst yours truly. Don't go anywhere. Welcome back to Opening Bid. I'm locked in again on the bumbling and stumbling Intel. Shares are in the green today as President Trump walked back his apparent dislike for the company's new CEO, Lip Bhutan, after meeting on Monday. Don't be fooled by the upside price action in Intel stock, however. I would say this should ultimately apply for the rest of this year. This isn't the case like Apple, where CEO Tim Cook praises Trump and the company is exempt from various tariffs. Intel is a fundamental disaster right now. People in the industry I talked to are unsure if the company will ever come back to a state of healthiness, given how fast AI chip development is occurring and how far behind NVIDIA and advanced micro devices Intel is. Intel stock is down 58% in the past 5 years for a reason, or better yet, a number of reasons. Let's turn now to our stock of the day. Today, it's all about CoreWeave. Momo AI trade CoreWeave will report earnings after the close today. Stock has increased almost 4 times from its late March IPO price. Here's what I think the street is looking for from CoreWeave. If it could hit these marks, the stock could renew its upward bias that has been on delay since early June. 1, revenue has to beat estimates by a double-digit percentage. Key CoreWeave customer Microsoft had a huge quarter on the AI use front, so CoreWeave should have theoretically benefited. 2, backlog needs to have increased compared to the first quarter. 3, earnings need to thump estimates. I've heard some concerns on how CoreWeave's earnings come in or could come in given robust investments in CapEx. And 4, management tamps down concerns on how much stock could be sold by insiders later this week. CoreWeave has an expiring IPO lockup that frees up 83% of Class A shares beginning the morning of August 15th, points out Citi. If a lot of CoreWeave stock is dumped, it could weigh on the market price in the near term. CoreWeave's valuation leaves no margin for error. Stock trades at big-time premiums to the broader market. Still with me in my roundtable, Jim Bianco, Bianco Research President, and Yahoo Finance Senior Reporters Brooke DiPalma and Ines Ferre. Brooke, I want to go over to you because you've been examining how CoreWeave essentially ties in with Microsoft.
Yeah, absolutely. What we do know is that Microsoft is one of CoreWeave's biggest companies. And if you take a look, not only is Microsoft one of their biggest companies, but we also know that IBM, Meta, those are additional companies that CoreWeave works with in order to supply their servers and for these big AI semiconductors. And so it's important to note, too, that NVIDIA also is a partner with CoreWeave. We know that CoreWeave rents out computer servers equipped by NVIDIA, and NVIDIA also has a stake within the company. And so it's been interesting to watch this stock movement over the past month. Right now, what we've seen is CoreWeave see about an 8% jump as these companies have reported their earnings and reported that their cloud businesses have outperformed expectations. NVIDIA is about a 10% jump over the last month. But as you said, this stock is up more than 240% since the IPO. And so definitely trading at a premium here. But what we do know is that based on its S1 filings, these are key players in the game right now when it comes to the AI revolution. And so CoreWeave certainly benefiting from having a part in that.
And as I always get a little nervous ahead of an earnings report where so many things appear to be going right. Sentiment on the AI trade is good. Microsoft performed well. Google crushed it. The stage theoretically is set for CoreWeave, but I did call out some concern how their earnings may come out because of investments they're making.
Yeah, that's right. So that's one of the concerns that the street has. And also that lockup period that you just mentioned, that could cause some volatility. But you do have Wall Street analysts, some of them saying, look, the stock can absorb this. So even if you do see selling after that lockup period expires this week, then you would see the stock sort of absorbing this. As you mentioned, it has had quite a run, and it really underscores what the market has been leaning towards. The fact that you have AI that it's looking forward to. So what Wall Street has been talking about throughout this entire time when we've seen these tariffs being rolled out and this uncertainty over what's happening at the Fed, they are expecting a cut and they're expecting AI to move this market forward.
Jim, real quick over to you. This has been another CoreWeave, really one of the hottest IPOs of this year. You have Figma, Firefly last week. What do you attribute some of these early gains for these IPOs? I wrote over the weekend in our morning brief newsletter, I think it reflects more mature companies coming to market, but would love your take.
Yeah, I think it also reflects the hope and maybe the hype of AI, and that AI, count me in on those that think it's going to be bigger than the internet itself was in the late 90s or early 2000s once it achieves its potential. But the big thing you got to keep in mind with a company like CoreWeave or NVIDIA or the rest of them is they're all customers of each other, because we're still at the picks and shovels play. We're still at the let's make AI play. We're not at the what is Ford doing with AI to change its bottom line, or what is Procter & Gamble doing with AI to change its bottom line, or what am I doing with AI to change their bottom line. We're using a little bit of it like the rest of them, but it's not changing our bottom line. So it reminds me of that old Bill Gates line that technology over the next 3 years will underwhelm what you think it's going to do, and over the next 10 years it's going to overwhelm what you think it's going to do. And if it underwhelms with these valuations and this hype, we might be seeing a little bit of disappointment somewhere down the road.
Jim, I wonder how Fed Chair Bill Pulte would use AI. No, I'm just kidding. I'm just kidding, Jim. Just keeping the mood light on this Tuesday morning. All right, let's fire up our question of the day, friends.
Use it to cut rates to 1%.
Yeah, no, fair enough. See, I knew you would tie all this together, Jim. I appreciate you, man. All right, my question of the day is this. The NASDAQ has notched 18 record highs so far this year. But what goes up must come down. And some of those mostly tech valuations are pretty darn lofty. Looking at you, Mag 7. You can check out just how big tech has gotten with the Yahoo Finance sector view on our lovely platform. There it is in all its loveliness. So my question is this: is a tech stock crash coming? Let me bring the roundtable in here. Jim, I will keep with you. You are in fact the hot hand. You can't just come out here and talk about a potential stock crash for the sake of doing. There has to be a trigger point. And I think you brought up a good point earlier in the show that maybe we do get the 10-year yield going to 5%. Is that the trigger that would, I guess, just send big tech back into profit-taking mode?
I mean, it could. It definitely could, because if you look at the flows, the one thing that people forget is that there's massive flows into bond funds, and there's massive interest in yield right now because there is a yield. And if we were to get more yield into bond funds and the like, you could see money moving that way, and that could definitely give indigestion. And keep in mind, if you take the top Mag 7 or the top 20 tech stocks out of the S&P, it's hardly doing anything. The Russell is still down on the year, and the mid cap, which is still unchanged on the year, because they don't have very much of this big AI tech in it. So if you were to get higher rates, it could really be a drag on the stock market even further.
Jim, I imagine you get a lot of questions from your clients and folks that use your research on the Mag 7. What are you telling them to do with some of these names today?
Yeah, that's a good question, because I think it's a risk. It's a risk. I think you need to understand that if you want to play some of these Mag 7s, you want to play them for big gains, you also have to be prepared for big losses. So you need to adjust your risk. I think the problem I see with a lot of people is they think it's all a one-way street. They look at all the rallies in some of these stocks, and I'm thinking Palantir right now, and they think that it's just, well, that's the way it's going to be, and it's just a money printing machine. Well, it is until it isn't, and that's the biggest risk you have to take with them.
Yeah, you can go look no further than C3AI. I mean, the stock crashed yesterday, Ines, and I think it was a real wake-up call to folks that not all AI stocks are created equally, even if you have AI in your corporate name.
Exactly, and we have had Wall Street analysts talk about that you really want to stay within the ones that are doing well, that have strong earnings, and of course everyone names those big Mag 7 stocks and the big players within AI. But so not all of them are created equally. But look, you've had B of A's Hartnett talk about the risk of a bubble and signs of a bubble, and I mean you've had investors and retail investors coming in and buying aggressively. And there's been a lot of dip buying. So the investors have been increasingly going further and further out into risk. And we saw recently, just a couple of weeks ago, this sort of meme craze again. So when you get to these levels and you're near record high levels, you expect a pullback at some point. We just don't know what the catalyst is going to be, and sometimes it happens like that. Something happens, and then you see a pullback.
Brooke, real quick, CoreWeave stock hasn't gone anywhere since June.
Yeah, well, certainly what we've seen, though, is a bit of a move in these, summer months as these companies reported. We do know that over the past month alone, as we got more data out from these key AI players, that CoreWeave has moved in line. But now we're seeing CoreWeave under a bit of pressure as maybe this hype around how the company is playing into the AI revolution is not all that it's banked up to be. After such a premium, such a run since its IPO, we are seeing it under pressure this morning. But certainly what I, also want to say is that before CoreWeave sort of has played such a role in this picture, we did see during that sell-off in April, so many investors move away from these Mag 7 as this fear really roiled the markets. And now we've seen investors, as these earnings, like Ines said, have really come to fruition, have really surprised investors. We see retail investors looking to get back in. And so it'll remain to be seen really how CoreWeave does play into this picture, but we know that over the past month, the results from these big AI players have led to results for CoreWeave.
All right, a big thank you to my roundtable today, Jim Bianco, Brooke DiPalma, and Ines Ferre. Appreciate you guys.